All right, thank you for joining us. Attendees are starting to come in the room from the other one. I'm gonna try to talk really slow for a minute while we wait for people to come in and change Adam Johnson's name to his actual name. Joe, if I spell it wrong, correct me. Oh, you know what's funny about that is I just about did spell it wrong. We good now?
Thanks, Todd.
Okay, we've got a fantastic moderator here. Nick, you're going to take it over, bring high energy, because it's already been sort of a long day for people to sit through. Dr. Dotzer was awesome. I was taking notes, and then 3 general sessions. Now we're into a breakout session. So let's talk investment. I'll be here. I'm going to be in the background, but if you need anything, wave, hey, Todd. I'll also let you know when there's 5 minutes left with my high-tech 5-minute left device.
Very high tech.
Because we got to stay on time. Thanks, everybody.
Awesome. Thanks, Todd. Good afternoon, and thank you to everyone who's joining us today. My name is Nick Koricanac. I'm a Senior Vice President in the Loan Origination Group at WINTRUST Commercial Real Estate. I'm very excited to have the opportunity to moderate this distinguished panel this afternoon that will cover a variety of topics relating to investment real estate in today's market. None of us can ignore that we find ourselves today in the middle of a historic time, both politically and economically, not to mention the fact of being in the middle of a global pandemic. We're going to focus our discussion today on how various asset classes have been impacted by these respective events. Topics will also include where investors are finding yield in today's market, and also include the 1031 like-kind exchange and how that can be changing as we move into 2021. I'm now going to have each panelist introduce themselves, and we can dive into our discussions. John Murphy, will you please lead us off and introduce yourself first?
Sure. Thanks, Nick. Morning / early afternoon, everyone. My name's John Murphy. I manage the real estate banking team for PNC Bank in Chicago. PNC Bank is, well, I should mention, we recently announced the acquisition of the U.S. assets of BBVA, and upon closing that acquisition, we will be the 5th largest bank in the country with physical locations in 29 of the 30 markets across the country. Our real estate platform is a national platform, though, and my team is responsible for covering sponsors in Chicago and Illinois and Minnesota / Minneapolis. We finance all types of real estate, really, with the exception of for sale housing. Our clients are private developers, owners, operators, REITs, institutions, and funds. And I guess just a bit about myself. I've been with the bank I'm in my 20th year now, and happy to be here this morning.
Thanks, John. Dan Wagner.
Hey, Nick, it's great to be here this morning. I got to tell you, I love being able to put on a tie and a suit, which is an unusual experience. So it's good to be with all of you guys looking good today. I'm honored to work for the Inland Real Estate Group of companies. Inland was founded over 50 years ago by 4 Chicago public school teachers, and they were absolutely been amazing with their expertise in real estate. Inland was at one time the largest landlord of Chicago with 42,000 apartments. After the tax laws changed, we utilized the 1031 exchange and did exchange people into fractional share interest of Walmart's in regards to our limited partnerships. So that in and of itself was able to jump Inland into the stratosphere of REITs and people that want to invest in securitize real estate. So out of all the companies, we have purchased over $80 billion worth of different deals and over $48 billion of commercial real estate deals. So it's an honor to be here and to represent Inland, and I can't wait to begin our discussion.
Great. Thanks, Dan. Dan Rosenberg.
Hello, everybody. Dan Rosenberg. Happy to be here. I'm an executive vice president with Bellwether Enterprise. We are a national commercial and multifamily mortgage banking firm doing debt and equity placement all around the U.S. in all the property types. I lead a team here in Chicago that is active in Chicago and nationally. And our client base is anyone from a middle market sponsor, high net worth individual, family offices, as well as REIT and fund sponsors. And we do placements on anything from new construction financing to stabilized assets. So Certainly has been an interesting 9 months, and look forward to discussing 2021 forecast with everybody.
Thanks, Dan. The real Adam Johnson.
Very good.
My name's Adam Johnson. I'm an executive vice president with NEI Hiffman. We've got about 220 folks out here in Oak Brook Terrace. We're just kitty corner from Dan. We focus on office, industrial, retail, brokerage, and management throughout the suburbs. We do a few buildings downtown as well. All in, we've got a little under 100 million square feet that we manage and lease for our clients. My focus is on the office services and capital markets side, focusing on mid-cap office sales, kind of the 1 to 15 million range, working with private investors, family funds, developers, banks, kind of strategize on either selling or purchasing properties or advising them on timing of purchasing. So thank you for having me.
Thanks, Adam. Last but not least, Joe Powers.
Thanks, Nick, and thanks, RE Journals, for putting this on. My name is Joe Powers with Marcus and Millichap. We're the largest investment sales brokerage firm in the U.S. and Canada. We have about 80 offices, 2,000 brokers. I oversee the office here in downtown Chicago, where we sell apartment buildings, retail centers, office buildings, industrial, seniors housing, any income-producing property is our focus, as well as loan origination. So I appreciate everyone being on the panel and appreciate being here.
Great. Thanks everyone for introducing themselves. Joe, I'm going to lead off the first question with you here and just jump right into it. Obviously a common theme from all the introductions, it's been a very long 9 months since the beginning of March to where we are today. Joe, I kind of would love to hear your aspect and kind of touch on, given now that we are 9 months into this pandemic, it's kind of becoming the new normal. How has the pandemic influenced valuations and underwriting as we head into the new year compared to pre-pandemic levels?
Sure. Yeah. I think it was March 13th where the pandemic was declared, and a lot of people didn't really know what that meant. A lot of investors who were considering selling, maybe even had their buildings on the market at that time, hit the pause button and just were looking at how can they maintain their equity, how can they maintain their cash flow. And so the second quarter and the third quarter of the year were very quiet relative to a normal year. And then with that being said, in Q4, it's almost as though the floodgates opened up and transaction volume picked up pretty significantly. So in terms of activity, I think once people started to realize what the new normal was, the same motivating factors applied for people to transact. In terms of value, it's really across the board. It's hard to say, it's hard to give one answer to that question because it depends a large part in which asset class, which location, what does the rent roll look like. In terms of value, though, generally speaking, in Chicago, what I can tell you is that from a cap rate basis, apartments have stayed pretty flat from a cap rate standpoint. Investors who are looking to acquire have to consider, which I'm sure the lenders on the line will talk about, cash flow sweeps and reserves in terms of, their cash on cash returns. But in terms of cap rates, apartments have stayed flat. We've seen a rise in caps on retail, about 20 basis points. So certainly a higher level of risk on retail, but certain retail, not every retail. It's not an overarching theme. Well located retail with good credit has maintained fairly strong values. Office has ticked up a bit too in terms of caps. We've seen about a 20% basis point rise in those cap rates. And then industrial has seen a tremendous amount of cap rate compression over the last 10 years, where year over year, I want to say it was about 20 or 30% downward pressure on caps on the industrial market here in Chicago. So generally speaking, it's not a drastic change in terms of value. Certainly there's some changes in underwriting, which in large part is driven by lender activity, which you guys can attest to. But overall, that's what I'm seeing.
Sure. Great. Thanks. And then coming out of the pandemic, second quarter, third quarter of this year, as the vaccines are readily available to the general population, do you think it's going to be the multifamily industrials that are still the cream of the crop asset class and be the most resilient? Or do you think there's other asset classes that people are going to be more attracted to, say, come summer 2021?
It's a good question. I wish I had that crystal ball, right? I wish I could predict. Multifamily has always remained a very stable investment. It's an easier investment to get into for those who are, let's say, first-time investors, easier to underwrite for the most part. So I think multifamily will remain stable as long as, I think an additional stimulus will assist short-term in helping owners maintain that cash flow. and industrial certainly as well. But one area we've seen a tremendous amount of activity in year over year is the single tenant net lease market, where you've got a credit tenant who occupies a building on a long-term lease that's passive to the investor, where it provides a tremendously stable investment for people, where if it's like a Walgreens or any other creditworthy tenant, they can be confident that cash flow is gonna remain throughout whatever cycle that we reach. So I would say those three markets certainly are leading the charge. On the opposite end, the hardest hit segments from my perspective have been the hospitality business. We do have a hospitality team based in our Chicago Oak Brook office that's very active, and they've actually done fairly well in terms of transaction volume, but certainly we're seeing more conservative underwriting and values on hospitality, as well as seniors housing, which was hit very hard by the pandemic. Those investments have slowed down quite a bit, but yeah, in terms of resiliency, multifamily, industrial, net lease would probably lead the pack from my perspective.
Great. Thanks for that insight there. Adam, given your primary focus on suburban office market and somewhat in a similar line of questioning, we heard hospitality has been hit pretty hard. That's pretty obvious. How has the suburban office market held up since March of last year compared to now? Obviously, it was probably pretty dire, I would assume, when everyone kind of had the pandemic and stay-at-home orders. What are you seeing now in the marketplace, and what do you anticipate seeing in regards to what asset class is going to come out in the suburban office market and be the cream of the crop come summer of this year?
I think similar to, as COVID hit in March and kind of went throughout the year, you have these kind of transitional phases. And I think we're going to have these transitional phases coming out of it, especially in the office market, because there's going to be as tenants try to figure out what they do, the office market, the owners, investors are going to have to adapt with how they come out of it. And so I think if you look at kind of a 12 to 24 month stretch as we come out and folks start to come back in the office, whether that's going to be, early summer, fall, it obviously depends on how the vaccine rolls out. I think the easy eye test is if you drive up and down the street and you look at smaller tenant buildings. So those could be either smaller buildings or your BC class buildings that, in the last 5 or 6 years have been kind of turned away by a lot of investors because bright and shiny was the new and best thing. If you look at their parking lots right now, you'll see a lot of cars in them. And I think that's something that's very interesting, because if right now you see a lot of cars in those lots, that means they're utilizing their office space during, this COVID era. And you tend to think that coming out of it, they're still going to be using their office space. In comparison, if you go to more of the Class A corporate campus and you look at their office parking lots, you will see very little cars from an occupancy standpoint. And so when you kind of compare those two things, it kind of tells you, at least early on, the amount of folks that are going to be rolling out, what that effect is on those buildings. We think the B and C smaller tenant type buildings are going to be the ones that are going to still utilize office space the same. They're not going to change that much. And some of the larger blocks, the larger corporations, the ones that have more HR and logistic issues of getting people back in and how you handle it, are the ones that we think we'll be looking at a little bit differently, maybe a little bit slower to roll out. And we'll be trying to figure out how do they, make changes, either change their footprints moving forward. So smaller tenant buildings, I think, are the ones, at least initially, will come out the best.
Great. Thanks for that. I'm going to transition to some of the lenders now on the call here. The current lending environment certainly has changed over the last 12 months. I think we can all agree to that. It sounds like the volume of new deals being financed is down. However, there's still a significant appetite to get deals done in this marketplace. So Dan Rosenberg, given that you touch all asset classes, where are you finding the most success on placing new debt in the market today? Who are the most competitive lenders out there, and how selective are they being compared to March, April, May of last year, coming into the new year now?
Good question, Nick. When COVID hit in March, our business was pretty slow up until roughly June. Many of our clients were just grappling with the operational side of their business and getting tenants to pay rent and keeping the lights on and working with their lenders to make mortgage payments or get relief. Once we got through that period of time, things firmed up pretty quickly, surprisingly. I would say by July through the end of the year, we've had a very active and arguably one of our most busy periods of time. With that said, not all asset classes are alike. So we certainly were the most active with multifamily, industrial, net lease properties, and life sciences. Life sciences are super hot, and folks are looking at those very closely, and the cap rates are getting very competitive. With respect to lenders out there, we were very surprised with how quickly the various lending buckets came back and were active. Fannie Mae, Freddie Mac, and HUD on the apartment side are always active. They're government backed. Our tax dollars support them. That said, they've had various reserve requirements, which have made sometimes acquisitions and refinances tricky, which has opened the doors for other lenders to participate on the multifamily side, such as CMBS and life insurance companies and banks and pension funds. The CMBS market bounced back very quickly, and rates are extremely low. 10-year money is 3% or less today, give or take. So that's very good for the market. They have a ton of money, but there's a lack of deal flow for them. The life companies are about 50-50. Some are in, some are out, very conservative, but focused on the property types that I previously mentioned. We have a handful of people that work for banks on the call, so I won't spend a lot of time talking about that. But my observation as an intermediary is that the banks have sort of hunkered down. They really only want to lend to their best clients. And some selectively are using it to be opportunistic and go after their competitors' best clients that maybe those banks aren't lending to right now. So all in all, capital has not been the issue to the dry amount of investment sale activity. Capital is there. It's very plentiful, and I think will only increase.
So it sounds like there's a lot of dry powder still out there, which was the case before the pandemic. Where is that money wanting to go right now? If they could have their pick in a perfect world, what type of deals are garnering the most attention for them? As I know you raised some equity for your clients as well, in addition to the debt side. Sure.
So everybody wants distress. Where is that? Where's that distress deal? When can I buy it for 50, 60 cents on the dollar? Generally speaking, aside from the hotel space, which we're just starting to see some things work through the system, there really have not been many distressed sales. You probably can count them on one hand. And, that's because tenants are paying rent, lenders are playing ball, and they're, kind of kicking the can down the road. I think some of that will come to an end towards the middle to third quarter of this year. And either the vaccine rollout's going to be great and we're going to be back to some level of normality, and things will work themselves out, or things won't go according to plan. And I think that lenders will not be as friendly anymore and will need to make some moves. So people are waiting on distress, and whether it actually happens or not remains to be seen. I really don't know.
Sure. I can say in the beginning or middle of March, I probably had 10 phone calls on March 15th to 20th to see if we had anything to sell already to some of my bigger clients. So they're already ready to jump on these opportunities in March. I can only imagine how many calls you're getting and everyone else is now these days. John Murphy, Dan just stated that there's tons of dry powder marketplace. I would agree. I think everyone would agree here. From the commercial banking aspect at PNC, what is the current appetite and demand for construction lending? And how has this appetite changed since the beginning of pandemic as we head into this new year?
Yeah, well, first I want to say that a lot of what Dan mentioned at the end regarding the commercial banks is true. That there is really a focus on existing clients, and in some cases, maybe tier one prospects, where you have an opportunity to pick up some slack where their existing banking relationships are letting them down. And part of that is driven, and this will go into kind of the appetite and how it's changed from the beginning of the pandemic until now. But some of that is driven by what the banks experienced at the beginning of this pandemic, which was a lot of REITs and large corporations drew on their lines of credit, sheets, expanded in some cases upwards of 10%. And we saw some lenders that were just tapped out because they didn't have lending capacity anymore as a result of it. And then you couple with that a ratings migration in some of those asset classes that are hit harder, like hospitality and retail, which requires the banks to reserve more capital, and couple that with some of the deferrals that the banks were providing. It really led to a situation where banks needed to determine what their cost of capital truly was, and then looking at market opportunities. What is our capital worth in the market today, and how do I underwrite a new construction loan today? I think that that some of the projections that people put together at the early stages of this pandemic were, they're all blown out of the water. I mean, a lot of people thought this, maybe outside chances 6 months, it's going to be a V-shaped recovery. And, I think in a couple select cases that may have been the case, but industry-wide was not. And so, right when the pandemic started, I would say that the majority of the banks were closing on those opportunities that were in their pipeline, construction or otherwise. Not all of them, but many were. And then the demand for construction financing really waned for 2 quarters. Sponsors weren't sure how, equity wasn't sure how to underwrite deals, and the banks weren't going to be ready to understand how to underwrite those deals either. So there was very little construction lending done through the second and into the third quarters. But both driven by supply and demand. Now, going into starting in the fourth quarter, I think we saw a return to planned developments, particularly in the multifamily and industrial space. Also, maybe in the single tenant net lease space, and it was really amazing how quickly the commercial banking world kind of came back to service those opportunities. Late third quarter, early fourth quarter, maybe there was 1 or 2 relationship banks bidding on a deal. End of the fourth quarter or the early part of this year, there's maybe 6 or 7 banks chasing those or issuing terms on those same opportunities, assuming they are in the favored asset classes, which is really where the development demand is. Pricing, was really wide. Second quarter, third quarter, if you were able to get a construction loan, probably in the 3, spreads were north of 300, floors were, 75 to 100 basis points. Now I think that the clients and sponsors look at the all-in rate, which includes the spread in the floor. And it seems, again, for like a multifamily or industrial building, that's tightened. And all-in rates might be 300 to 350. So still a little wider, but getting tighter. And I'd say, the same thing can be said for leverage. Mid-pandemic, second, third quarter, when leverage would have been 70, now it might have been 55. But today it's probably 65. So it's getting, we're not quite back at pre-pandemic levels, but it's getting closer.
Great. Adam, what are you seeing on the suburban office side for your clients when they're buying and transacting these days? Is debt readily available? Obviously, everyone keeps saying the cream of the crop is multifamily and industrial. What are you seeing out there to get your clients financed and kind of move deals along?
I think, the debt markets have, to a certain extent, not just in office, but across all asset classes, having a low interest rate environment is a huge benefit to investors. Because they can, obviously, look at their cash on cash returns and push them a lot higher. And so I think the debt's been available. I think you're getting lenders that are almost to a certain extent becoming more like the investors themselves. They're really diving into these buildings a little bit deeper than what they used to. Credit has always been an important determinant of allowing additional capital for a property. Now it's not just about the credit, but it's also about who are the tenants, what do they do, how do they utilize the space, do they have a lot of people in their office, do they plan on having a lot of people come back, people want to do tenant interviews. So there's a lot more intricacies that are now going into just trying to sell a property. It's no longer look at the balance sheet, look at the cash flows. Yeah, this looks good. Obviously, it's, the sponsor is always kind of priority one for most lenders, looking at their experience, cash on hand as well. But really diving into these buildings and understanding them. I mean, all buildings are a living organism. You've got to understand the intricacies of it. And, we're seeing the lenders, get a lot more involved, which requires, on our side, providing a lot more detail, a lot more information than what we used to. And so we try to do the best job that we can to, you're not only selling the investors, you're selling their lenders now as well. But the interest rate environment, is helping us, is propping that office sector definitely up, because you've got, in the office sector, your yields are some of the higher yields right now. Obviously, industrial is going to be, lower, multifamily is going to be lower, downtown compared to suburbs. So you can get some attractive yields, and then you add the leverage to it, and it can be really attractive for investors.
And how about the leverage? I know John said, hey, pre-pandemic, and I would agree with him, probably 70% for the cream of the crop deals and whatnot. I want to be aggressive on with the best sponsors, going back to 55, spot on. Now it's creeping back up. There's a lot of more term sheets out there. Are your clients getting the leverage that they're desiring, or is it still a little subpar of what they want given the asset class?
I think it depends on what they're looking for. I mean, almost every investor wants, the magical mark where they, 70, 75% if possible. That was kind of your pre-pandemic numbers that people could get up to, could reach to. Now that's dropped a little bit, and everyone wants non-recourse. What's the magic number to get me to my non-recourse number? That's probably one of the first questions probably most of the bankers, get asked is, where do I not have to sign personally? What's the number I used to? And 65% was always the number that seemed to be the mark that people could do that at. We've seen that definitely drop down to kind of that 50% level, where the lenders are being much more cautious. Hopefully that will, as things open up and get a little better, that will increase. But we're still seeing a lot of people in kind of that 60 to 75% range. And, the higher groups are obviously signing personally, and the ones that are on the lower, spectrum are, really looking for that non-recourse.
Sure.
Yeah.
And then Dan Rosenberg, just to kind of close this up here, are you being able to push leverage on any of the lenders and conduits agencies? Is it still 65, 70? Is Fannie Freddie still at 80? What are you seeing out there to get really what your clients want?
No, good question. I mean, there's certainly been a little bit of an expectation resetting with borrowers, but that said, with the agencies, it's still 75 or 80% if you want. I would say with CMBS, things might be down a couple percentage points, but for the right asset class and the right borrower and the right transaction, you can get up to 75% again for multifamily, maybe for grocery anchored shop, for a shopping center, maybe for industrial. But things are down a little bit, but there's still, it's amazing how quickly everything bounced back.
Great, thanks for that. Joe, earlier in our discussion, you mentioned that the investment activity greatly rebounded in the fourth quarter of the pandemic. I know you do a lot of net lease deals, a lot of trades in apartments. Is there still a significant amount of 1031 trades occurring in the fourth quarter, and kind of what you've seen as we head into the first week of 2021?
Yeah, absolutely. We do a healthy number of exchanges on behalf of our clients, and the fourth quarter always produces a lot of exchange capital. Coming into January and February, the amount of capital that's in an exchange is probably greater during that point in time of the year versus any other time. Just people trying to hit their numbers by the end of the year and place that capital within the time frame. So haven't seen a much of a change in terms of the volume of exchange capital. just pretty steady as it relates to just the overall transaction velocity. So yeah, we're still definitely active doing exchanges, and right now, especially during this time of year.
Great. Dan Wagner, I didn't forget about you. It's your time here. With the new administration coming into power in a couple weeks, we have a new Senate in place as of yesterday or the day before its election. Can you discuss what the future of 1031 like-kind exchanges could look like moving forward? And what are the big drastic changes from how we know it today, kind of moving forward, and what's been proposed by this new administration?
Absolutely. And today's conversations have been great. Politics is a part of all this conversation, really. One of the reasons why we're particularly interested in the 1031 is we're the largest securitized 1031 company in the country. And so people are able to sell their property and get a fractional share interest into what we have. So the 1031 is near and dear to our hearts and to really the whole commercial real estate world's heart. What's happened is that you have President-elect Biden's campaign highlighted during the campaign that they wanted to eliminate the 1031 exchange. They wanted to stop the stepped up basis. They wanted to make capital gains to be taxed at ordinary income. Those things obviously scare the world of commercial real estate. So is that going to happen now that when President Biden takes over? Clearly, people were looking at Georgia as kind of being the stopgap for everything in the Senate, and Georgia's races were lost. So you have the House and Senate are Democrat, and then you have President Biden. They wanted to use this money from the tax code to be able to pay for childcare, healthcare, that kind of thing. And those aren't bad ideas, but it's our duty as commercial real estate people to be able to explain to our elected officials why that isn't good. And especially now that COVID, the commercial real estate world is having a very difficult time. So what we're trying to highlight is that we had yesterday was a great example of the discord in our country, and we all pray for peace. This isn't what we typically expect in our universe. Having the discord is a major factor in this whole world of tax. You have a very close majority in the House now. You have a razor-thin majority in the Senate, and there's a lot of stuff going on, obviously, with the vaccination, with the rollout, with people wanting to get more PPP loans. So a lot of politics is coming to play, a lot of outside issues. So the idea of campaign promises and things like that is in our experience and talking to all of our folks in DC, is going to be put on to kind of the back burner. And so there's nothing immediately is going to happen to our 1031 universe. We believe that everything is going to be clicking along normally. If the administration wants to do something related to tax, the thought is from what I gather is that they would possibly look at bringing the corporate tax rate from 21 to 28%. And then they like to possibly increase the top level of the tax rate too. But we, as commercial real estate folks, we have to remember that we're part of a bigger group. All of our organizations, all of our companies are involved with the Real Estate Roundtable, the National Association of Realtors. It's a lot of different groups, IPA. We are working together and coordinating with the Federation of Exchange Accommodators. We have the microeconomic studies that have been done from the Link Petrova studies. Then we have the macroeconomic studies that have done. The National Association of Realtors verified that over 60% of realtors have done 1031s. But the big deal is to be able to let the legislators know, hey, when you look at the 1031, buyers, they renovate, owners maintain. And when you do a 1031 exchange, a lot of stuff happens to the economy. A lot of stuff locally. There's about 34% more money's put into the deal when you do a 1031 exchange, as we all know. But we have to really take a look at our relationships we have with our elected officials, and we have to, as professionals, all of us on this call need to know who our congressman or woman is and build a relationship with them so they understand why this stuff is so important. Because this whole tax world is a very blood and sinew of every single discussion that everyone has talked about today. We have to know that government is our partner, and we got to make sure these elected officials understand that we are here not as Republicans, not as Democrats, but as Americans to try to put food on the table for all of our families and to make our country better.
Yeah, so let's say there is a slight change to 1031. Who knows what anything would look like? No way you would know right now. But if there is even a slight change, do you think that would have a significant impact on the transaction volume that would occur? I know Joe said a lot of the volume is already happening fourth quarter and he's seeing a lot of it now. Well, in your best guess right now with what you know, what happens with transaction volume if something does occur and change in the 1031 world?
Sure. So Nick, I think what happens now is that people know that nothing's going to happen immediately for 1031. I think that you're going to see the transaction value for 1031s to go up. I think people that believe that, hey, I gotta get into this 1031 now because I know it's here. They're going to go full in and work really hard to get their deals to happen. And the 1031s are going to, I think, go just wild. I think right now it's a big time for 1031s. And I think I believe that all of us working together, the 1031 is going to be here it's been in the tax code since 1921. I believe it's going to be, another 100 years, it'll be in the tax code. But because of all this discussion, I believe we're going to be seeing a big influx of 1031s.
Hey, Nick, can I chime in real quick on that?
Please do.
Just to add a little additional insight from our perspective. If I'm putting my investor hat on and I have any concern about the 1031 code changing for the worse, if I'm looking at my asset and I'm looking at the equity that I've built up, I'm looking at the value that I've created, and I don't think I have any more room to grow that, coupling that with any significant amount of motivation, whether it's a partnership dissolution, whether it's a management issue, whether any of the common motivating factors why people sell, I would encourage people to take their building to the market right now for all the reasons Dan described, because the situation with the exchange policies certainly isn't going to get any better. There's only a chance that it might get worse. So again, if you're in a position where you're holding an asset that you've accumulated a significant amount of value, now's a good time to transact.
That's great advice. Did anyone else have anything?
Nick, did you want me to talk about Chicago and what I think's happening politically there?
Yeah, we just got the 5-minute sign, so that's why I'm going to end on here. So Dan, if you kind of want to lead on that, my question was to Dan Wagner, Dan Rosenberg, and the whole crew is, the pandemic and other factors such as taxes, civil unrest, the city and state's debt. How has that affected investors' appetite? So Dan Wagner, if you want to lead us off on that, that'd be great. And then Dan Rosenberg, if you could follow up kind of on the equity side and say, hey, are sponsors still wanting to come to Chicago given all these effects of the taxes and debt that we have, coupled with the pandemic and civil unrest? And I think we can kind of wrap it up there with everyone else's thoughts.
So because inland's been so involved, we've been in the business for 50 years and we've developed so much in Chicago and all around the country. We're part of a group called Renew Cook County. And that group is really working hard to really talk to the elected officials, let them know that we need their help. You have Assessor Kagi for Cook County that has reassessed downtown Chicago, and those reassessment numbers are going to come out in February and March, and that's going to really stop the hearts of some people. We are very, very much concerned about that. We need to let our elected officials know that rent control would be a killer for anybody that wanted to invest in any of our multifamilies. The affordable housing ordinances that they're trying to propose are other ones that are, again, killers for investment. And any idea of additional taxes would just be another killer. But when you have everything that happened with pandemic, we don't know if people are going to be coming back to downtown Chicago anytime soon. We hope they do, because we need that. We need that confidence. But the population loss of downtown Chicago, the Kagi reassessments, the politics, those are very concerning. We're very happy that we stopped the graduated income tax. So those are important issues. So I can just leave it on that.
And then Dan Rosenberg, if you want to follow up quickly on kind of what you're seeing on the investor appetite, given everything Dan Wagner just said, are people still wanting and willing to come here, or are they looking at other markets as being more beneficial, not wanting to deal with the mess of the city and state's financial wherewithal?
Sure. I want to jump on what Dan Wagner said about the graduated income tax. I mean, that would have been beyond brutal. So that's certainly great that didn't happen. Many investors and the institutional investors have not wanted to look at Chicago for the past 12 or 18 months for all the reasons you've mentioned. The reality, though, is every investor is greedy and they're looking for yields. So I think what you'll start to see in the back half of this year is you'll see some relative value in Chicago compared to some of the other major cities, and you'll see investors talk themselves back into coming here. No different than when you get late cycle, they start buying office building in Des Moines, Iowa, because of the relative value. So I think you'll see the relative value play come into Chicago towards the end of the year.
Sure. And we'll finish with Joe, Adam, John. If you guys want to give any insight, like John, have you been seeing any of your clients really say, hey, I got to go look at Minneapolis, Indianapolis, you name it, in the Midwest instead of Chicago? And we got 1 minute to wrap it up here. So if you three could be brief, I would appreciate that.
Sure. So the majority of our clients are diversified nationally, but those that are focused in Chicago, I'd say it's been a trend over the last three or 4 years to try to diversify out of Chicago. And and then I'm not saying there is anything wrong with Chicago, because I think what people end up finding is that the yield there in the other markets, and their core competencies are here in Chicago, and there are plenty of demand drivers in the city to keep people interested in investing here. The biggest problem is uncertainty. The uncertainty around the real estate tax line item. Once people can put the number down, I think we'll see some of the more larger institutional investors come back as well.
Great, thanks. And then Joe and Adam, if you guys want to add anything, we got to wrap things up in a couple.
I'll agree with.
Go ahead, Adam.
Yeah, I'll agree with John in terms of uncertainty is real estate's worst enemy. And so when we bring up Cook County is is a bad word to a lot of people, and it's because of that uncertainty. If you know, hey, this is where your taxes are, this is where it's going to stay, you can plan for it, you can predict for it. But the uncertainty we've got to fix, in politics and taxes and everything else. So that's definitely something. Joe.
Yeah, I'll keep it brief. I know, within our firm, we do a lot of work with out-of-state investors and move capital throughout the country. And here in Illinois, we typically bring in about 40 to 45% of capital from outside of the market. That number stayed right in the same range in 2020, despite all the headwinds and the challenges, for a lot of the reasons that John described. If you look at the landscape in a New York City or a California, and you deal with the politics there, or you deal with the natural disasters and wildfires in California, the issues we deal with in Chicago are in some eyes, significantly less of a concern, right? And so when you tack on the yield that you can get in a market like Chicago and still have that same fundamental value of a world-class real estate market with a diverse economy and all the things that we have going for us, it's still an attractive investment opportunity for out-of-state investors.
Awesome. We got to wrap it up, guys. I want to thank all of you for your time and engaging in this discussion today on the various topics. I also want to thank everyone for tuning in. I think there's some obvious headwinds that we have in Chicago heading into 2021, but I believe I can speak for the group that we're all optimistic about the real estate investment part of Chicago heading into 2021. So thank you again, all of you panelists. Thank you again for everyone out there. Todd, I'll flip it back to you.
Thanks,
Awesome,
Nick.
fantastic.
Thanks, Nick.
Yes, thanks everybody. Great panel. This won't be the last time we talk capital markets in 2021. So check out our website, rejournals.com, and we'll have more events and hopefully have some of you back. This is the moment when you go back to the lobby and choose your next breakout session. You have property management, industrial, multifamily to choose from. And I'm going to close this down. If you found this session, you'll find the next one. See ya.